Okay, let's keep going, guys. Can you hit the volume on that, if you could, Claire? Just hit the volume all the way down. Thank you. Okay. Okay, guys. This is the beginning of Lesson 10 of Law and Practice. We are in this book, and we're going to be starting on Chapter 16, talking about real estate taxes and how they're handled. We're not going to spend a lot of time in this chapter because we cover taxes so heavily in Colorado, and I like it the way they do it in the real estate manual, where it should be tweaked to Colorado. But nonetheless, it's good to know the generalities of taxes, etc. And so let's go on page 237 and flip actually to page 238. Let's look at that second paragraph on page 238, where it talks about the word that you need to know in connection with taxes is the word levy. It just means charged against, as in. A tax of $1,000 is levied on that property, as an example. And taxes in real estate are called ad valorem taxes. Ad valorem means based on the value or according to value. According to value. We all have ad valorems on all of our properties. We might have additional special taxes if they came in and did something to our property and then put a special tax on it. But we all have ad valorem taxes. And then a special assessment in the middle is what they're talking about. Maybe they came in and put a sidewalk in or paved the street. There was a dirt road. And they put a special assessment on everybody's property. But not everybody has a special assessment. We all have ad valorem taxes. And look at the last paragraph there. Assessing property for taxes. The word assessed really means to assign or give a value to something. The assessed value is not necessarily the actual dollar value of the property. A municipality may, for example, assess property 50% of its market value. We're on page 238, last paragraph. And market value is the price the property would bring in a fair and open sale on the real estate market. And of course, market value, we talked about this in appraisals, most, what's that word? You want to remember? We talked about appraisal is the most what? What's that word? Begins with a P.
Probable.
Probable, most probable price, yes. And the percentage that is used to calculate the assessed value is called the assessment ratio. When we get to Colorado, we'll cover this in greater detail. In Colorado, our assessment ratio is 9.35% on 1 to 4 units, and on vacant land and commercial, it's 29%, 3 times more. And again, you can write that down if you want to. We're going to cover that in Colorado in much greater detail.
When does Colorado start?
Pardon me now?
When are we going to start doing Colorado?
When are we going to start Colorado? On Wednesday morning.
Oh, good. Okay.
Wednesday morning, yes.
Awesome.
And now, really, guys, remember, tomorrow, what we're going to do are those 2 80-question quizzes. Have you been working on those over the weekend? Hope you have been. Don't space them. You need to have both those done by tomorrow morning. 160 questions. So tomorrow's the most important day of the whole curriculum. We cover this entire book twice tomorrow, and that's not an exaggeration. We really do. So we have. Let's go through values one more time. We talked about this the other day in appraisal, but someone puts a contract on a property. That's the contract value or contract price. Then that contract goes to an appraiser, and an appraiser doesn't value that property to the contract, but lets the market tell him if that contract is accurate. If the real estate broker or whoever wrote up the contract did their job correctly, it should be the same as the market value. So we have contract value or contract price, then you have market value that's done by an appraiser, then you have assessed value that's based on either market value or market price. Market price is what they'll use for assessment if the home sold recently. And they'll say that's the market price of the property. That should be the same as market value or very close to it. And then you multiply that by an assessment ratio. Take the market value or market price and multiply it by an assessment ratio, which in Colorado is 9.35%. 9.35%, which means that every $100,000 worth of property value on 1 to 4 unit properties is assessed at $9,350. 9.35%. $9,350 is the assessment ratio for it. And then that gives us our assessed value. And how do we get taxes from that? Who remembers from Colorado? We have the assessment value when we multiply that by a mill levy. A mill levy, remember that? And what is a mill? A mill is 1/10 of 1%. A mill is 1/10 of 1%. Plain and simple. Let's look at the top of page 240. It says tax rate, very top of the page. Tax rates on a municipality are based on a calculation involving the budget needs of the community and the total assessed valuation of the community. The municipality must first arrive at a dollar amount for its annual budget, and after that figure is adopted, the municipality looks at its tax base, which is the total assessed valuation of taxable property within the community. And this surprises some people. A lot of people think the government first just gets in all the taxes they can and then they do a budget. No, they actually do a budget ahead of time. And then they handle it accordingly. We talked about a mill. Look at the bottom of page 240. When the tax rate is expressed in mills, tax rates frequently are expressed in mills or as a millage. A tax rate expressed in mills per dollar of valuation. As I already mentioned, a mill is 1/10 of 1 cent, 1/10 of 1%. A mill is 1/10 of 1%. Don't think of it as 1,000th, because we already have documentary fees, which we've talked about, and closings, which are 1/10,000. And if you think about a mill as 1,000th, you're going to get them confused. So think of mill as 1/10 of 1%. So you're watching the TV and they say that there's an election in another month, and they say if you pass this tax increase, it's going to increase the mill levy by 4 mills. That means it's going to increase your taxes by 0.4%. So you know now you can even vote intelligently. How many people know what a mill is? Nobody. Not too many people out there know what a mill is. You guys do. And again, a mill is 0.1% in every county, every city, every state has a mill levy that it uses for that city or for that county primarily. And then equalization rates, page 242. Now this is interesting, and people don't realize that counties and cities will do this. Let's say that Adams County looks at its 2,000 square foot homes and says our 2,000 square foot homes are going for $100 a square foot. So they're going for $200,000. 2,000 square foot homes, $200,000. And Jefferson County, right next to us, their 2,000 square foot homes are going for $300,000. So let's increase our equalization rate to equal Jefferson County. So they'll actually artificially raise the amount of assessment they're going to put on a property to make it more in line with an adjoining county, or a county that they're in competition with, just to increase the tax rate. And that's called an equalization rate. Look on page 243. 243. You've got property tax exemptions, bottom page 243, second last paragraph. And some properties are exempt from taxes, of course, government facilities, churches, colleges, schools, things like that are public. And you've got other property tax exemptions also. There was a time when senior citizens over 65 and older didn't have to pay any property taxes in Colorado. Then they made it where they only had to pay half their taxes. Now they did away with that. They have to pay their full taxes, just like everybody else. But you'll see that come and go. Let's go to page 244. We talked about middle of the page 244's partial tax exemptions. As I mentioned, senior citizens we're only paying half of it for a while, but then they got rid of that also. And on page 245 it talks about protesting assessments. So I get my assessment, and every odd year is an assessment year in Colorado. So 2013 was an assessment year, and by March or April of 2013, everybody got their assessment on their house. So they're telling us the county told you how much your home was being assessed at. And if you didn't like that, you could go down there and protest it. And you can, but in Colorado you have 30 days to do it, which is more than almost any other state. Like Kansas, it's only 10 days to go down there and protest it. But if you do protest it, it's expensive. You have to get an appraisal on it. That appraiser usually has to go down there with you. So it could cost you quite a bit of money to go down there and just protest your taxes and get them dropped. So make sure it's worth your while to do that. Look at page 245 at the bottom, tax liens and tax sales. And what is a lien? A lien is what? Anything to do with money on a property is a lien. Tax liens, mechanics liens, mortgage liens, all of those, of course, have to do with money. Let's read the very last paragraph down here. We talked about this a little bit in our last session. We've talked about it several times during this course, and we're going to talk about it in great detail in Colorado. But let's read this last paragraph on page 245. A tax sale. One way for the city to collect the money you owe in taxes is to conduct a tax sale. The city sells your tax debt to someone. That person pays the city what you owe. If you don't pay that person back, usually including some kind of interest or penalty, that person can claim ownership of the property. Before and during this action, the property owner has a right to redeem the property by paying the taxes plus any penalties or interest that apply. The right to do this before this tax sale is known as the equitable right of redemption. Highlight that. Before the sale is the equitable right of redemption. The right to do this after the sale is called the statutory right of redemption. And we're going to find out in Colorado that if you buy a property at a tax sale, you've got to keep paying the taxes on it, or else they're going to foreclose on you. And that person who loses their property in a tax sale has up to 5 years to get it back, 9 years if they're disabled. That's why in Colorado, if you pay the taxes on the property for 7 years, you can claim adverse possession on that property. It's right between 5 and 9. They pick 7 years. You can end up claiming that property in adverse possession. And the period before the sale is called the equitable period. The period after the sale is a statutory period of redemption. In Colorado, we'll talk about that again in much greater detail. Okay, now, it doesn't talk about 1031 exchanges, which is a part of commercial property investing. One of the reasons people invest in properties is for a 1031 exchange. And a 1031 exchange, if you want to write this down, take some notes on it, is where it's actually an equity exchange, You don't actually sell the property, you just trade equity with someone else's equity. The best example I can give you, and again it's called the 1031 exchange. 1031 exchange. 1031 exchange. And a 1031 exchange, like all these numbers here, 1031 exchange, there it is. It's 1031. It's not a 1031. Okay, it's a 1031. Just like if I tell somebody to go down and get a loan application, what is the name of the loan application called? It's called a 1003. It's called a 1003 for a loan application, a 1003. An appraisal is called a 1004. Kind of keep those straight so you know what you're talking about here. So if you tell somebody, you call up your mortgage guy or your lender and say, I need my guy to come down and fill out a 1003. They're going to go, wow, I'm talking to a broker who knows what they're talking about. Not a lot of brokers know that your loan application form is called a 1003. And you might call them up about the appraisal. Who orders the appraisal in a deal, typically?
Lender.
The lender does. You call up the lender and say, hey, you can call them and say, have you ordered the appraisal yet? Or you can call them up and say, have you ordered the 1004? And they're going to go, wow, they know what a 1004 is. And that's very rare for real estate brokers to know these terms. Now, a 1031 is something that every real estate broker should know. The 1031 exchanges, and that's just an equity exchange. And the way it works is this. I had a buddy of mine, best example I can give you, and he and his wife were driving around Grand Lake. This is back in the early 90s. And what happened is there was a bunch of people standing around, so they just stopped to see what all the commotion was. And there was actually a subdivision that they were auctioning off, and there weren't even any roads in there yet. They just looked at this hill, is what it was. And he ended up bidding on this piece of land and bought it for $9,000. And what happened is that several years later they had the roads in and everything else. It turned out his piece of property ended up pretty much right on top of the mountain with a fantastic view, everything. And his property was worth something like $130,000. So what he did is he took the equity that he had and traded it for a building down in Castle Rock. It was just an equity trade. So he had $135,000 that he traded for another building, and they just had a $135,000 equity exchange. And then you make up the difference out of your own pocket if there is one. And then he had that property for several years and ended up selling that, and he ended up buying another $450,000 property with the increase that he made. And then he ended up selling that property. He got $100,000 down and carried back the balance, and that was part of his retirement. And of course, what a 1031 exchange is you defer the taxes until the last sale that you make, and then you pay your taxes on it. And what happened to him, kind of an interesting story, he got sued by the guy he sold it to because the guy found out that it was built over a landfill, over a dump. And my buddy didn't tell him that. And so my buddy called me up and he said, it's built over a dump, man, the guy's suing me. And he said, what can I do? And I said, well, what about the guy who sold you the property? Did he tell you it was over a dump? And he said, no, he didn't tell me. I said, well, go after him. He said, no, he's dead. I said, well, first of all, it's public record. It's public record. It shouldn't be something that you should have any liability for. He said, well, my attorney says, usually you lose these kind of cases. And I went, really? I said, you probably should get another attorney. And I've had that attorney before. In fact, he was the attorney for one of the boards I was on at one time. And he was the go-to attorney. And I tell you what, the guy was not very good. He really wasn't. But anyway, what ended up happening, and I mean, this is public record. There's no way there should have been a lawsuit on this. Yeah, that's a public record is something that everybody on earth is expected to know. And so what happened is that he fought this thing, and his attorneys tell him the whole time he's going to lose. Isn't that something? And he's paying this guy. He ended up winning. And what else happened is I said, well, how come? I said, tell me more about what's going on with this case. And he said, well, I really screwed up. He said, well, after I bought the property, I found out that it was over a landfill, so I went to the county and protested my assessed value, so they dropped the value of my property because it was over a landfill. And this guy went and looked in the county records and found out I did that. So can you imagine? So that's why the guy's suing him now, because he thinks he sold the property for more than what it was worth because of that landfill. So anyway, he ended up losing. Or no, he ended up winning, actually. My buddy ended up winning the case. I knew he would. It's public record. But he had over $100,000 in attorney's fees. Isn't that something? And so anyway, so then he went over and sold the property again, got $100,000 back, and went and carried the rest again. So that's how his 1031 exchanges worked. You know, worked very profitably for him. And again, you're not trading the properties, you're just trading the equities in those properties to make it work.
I'm still kind of unclear on that. So when you trade it, so we bought this property in Castle Rock.
Mm-hmm.
He traded the equity in his property on the landfill.
He traded the equity that he had in the property for another guy's equity in that property in Castle Rock. They just traded equity positions. See, because if
the guy in Castle Rock then owned the property by the lake, and
yeah, then whoever he traded the equity with owned the property on top of the mountain. See, and then that guy might have done an equity trade with somebody else down there in the valley somewhere, whatever. And all you're doing is trading an equity position. And when you do that, you don't have any tax consequences. And then when you're finally done, your last sale is just long-term capital gains tax anyway, which was 14% until Obama raised it to 20%.
So the original property he had by the lake never reverts back to him.
The original property has never reverts back to him. No.
It's basically just like me going to a friend and say, hey, you want to trade houses?
You want to trade houses, pretty much, except you're not trading houses, you're trading equity in those houses. Like I'm trading my house for your house, and I have $80,000 worth of equity, and you have $70,000 worth of equity. Well, if you want to do the trade with my house, you have to come up with $10,000. Okay?
Why would you do that? Like, what would be a case where that would actually happen?
Why would you do that? It's for tax deferment until your last sale that you have. And so again, you're doing just equity trades. You don't have your long-term, you don't have capital gains tax exposure because of it.
Could you do this if you have liens or you owe anything on the property? Like if you don't own your property outright, can you do an equity trade?
Oh, would you do it if you don't own the property outright? Of course. Yeah, that's when you usually do it, is when you don't own it outright. And you just use the amount of equity you have. Like I said, I have a house that has $80,000 worth of equity, but maybe it's a $500,000 house. And you have an $800,000 house, but you have $70,000 worth of equity. Okay? In that case, we're just doing an equity trade. Okay? And so then again, you've got to be careful with that. Like you wouldn't come out well with that at all. Okay? You'd have to, if I have a $500,000 property, your property should be worth $500,000 too. And we're just doing an equity trade.
Because if you do that, you assume the other person's debt on the property as well.
Well, yeah, and you are assuming the debt. And that's just it. You got to make sure that it's an assumable loan, et cetera, if there is a loan on it. Yeah, all these things enter into it. And 1031 exchanges, like here in class, we talk about this for about 10, 15 minutes, and that's about it. There's a class that I give that's a 6-hour class just on 1031 exchanges. So there's a lot more that goes into it than just what we're talking about right now. But if you're ever interested in doing 1031 exchanges, go talk to a CPA or an attorney and get that set up correctly.
Are they common?
Common, they're very common. Yes, they're very common. They've been going on for about 30 years now. We've had 1031 exchanges. So,
does the real estate broker often enter into a 1031 exchange?
Does the broker enter a 1031 exchange? Yes. Usually they seek out a broker to do it. Yes, and there's brokers out there who just specialize in 1031 exchanges. Yeah, but mainly attorneys. And there's attorneys out there who do nothing but 1031 exchanges. Yeah, they come and go in popularity. And of course, 2008, 2009, 2010, they dropped off the map because properties were going down in value so badly that people didn't want to do any equity trading. So, but now they're coming back fairly strong, and you hear more and more about it. So that comes into play. Okay, so chapter 16. Let's go ahead and take just a quick 5-minute break. Here. Let's go to our 3-ring binder and go to chapter 18. Test Prep General, chapter 18, if you will. And this is kind of a hodgepodge of a bunch of different questions, but includes several tax questions. Now remember, when it comes to long-term capital gains tax, you have to have lived in the property 2 of the last 5 years. We'll cover that when we get to Colorado in much greater detail. So 2 of the last 5 years, if you lived in that property as your primary residence, then you can take all of your profit up to $200,000 tax-free. And if you're married, up to $500,000. But you have to have lived in it 2 of the last 5 years, which means you can do it every 2 years if you want to, and take all the profit. So let's go look at 18.1 here. Property taxes paid by the owner to the county made for federal tax purposes be, you can write off what? Your taxes and your interest is what we can write off right now. You okay, Roxy, on chapter 18? Yeah. And remember, and that's what we can write off, at least for right now. You know, there's a lot of pressure to get rid of that tax write-off. And for most Americans, that's the only tax write-off they have. And find out any congressman or senator that's trying to get rid of that and get them out of there.
Property tax and interest?
The taxes and interest you can write off. Yeah, or tax deductible. You don't get an all pay, you just get a percentage of it back, of course. That's the difference between a tax deduction and a tax credit. Let's talk about that just for a minute also. You've got, let's say you have a tax deduction for $1,000 and you're in a 30% tax bracket. Well, after you write it off, you get back $300. You're in a 30% tax bracket. You get 30% of it back. But if you have a tax credit on $1,000, you get back the entire $1,000. Back in the 70s, Jimmy Carter, when he had he had a tax credit on solar, and what had say you put we had a 70% tax credit on any solar that you put in your house. So if you put in $10,000 unit, $7,000 was a tax credit that you didn't have to pay. $7,000 worth of taxes. Remember a few years ago we had the $8,000 tax credit for first-time home buyers that they did away with. What a shame they did, because it worked very, very well. It really helped stimulate the real estate industry. But a tax credit, you get it back dollar for dollar. Let's go to number 2. Which of the following income tax deductions would be available to a taxpayer who owns and lives in a, we did that, the property tax? And which of the following owners would qualify for capital gains tax exemptions? This is one they really like on the state exam. And the answer is A. The owner has owned residential property for 7 years and had had tenants in the property for 2 years. So we assume that he lived in it himself for 5 of the 7 years. And then number 4, using the following information, which can be deducted for tax purposes by the owner of a residential single-family home? And we don't need those numbers. That's just to throw us. The answer is D, dog, the interest on the loan and property taxes. And a variance is, there's a slight change in zoning. And which one of those would represent a slight change in zoning?
C.
C, applying to the city for permission to reduce a setback. 6, and as if a zoning change in a subdivision results in the current use of being a violation of zoning laws, an owner who is permitted to continue said use would have it would do it a legal non-conforming use.
And what exactly is the non-conforming use? Because I came across this just a few.
Well, okay, what's a non-conforming use? That's where they come down your street and they zone one half of your street commercial. So now your one half of your street is a non-conforming. It doesn't conform to the zoning. It's own commercial, but it's still a single-family home, isn't it? Mm-hmm. But it's a legal non-conforming use, and there's no such thing as a non-conforming use permit. They're grandfathered in. They're grandfathered in. If the property is sold, the people can still keep it as a single-family home, even though the zoning is not the same as how it's being used. But if the property is ever sold, it has to be rebuilt in conformity with the new zoning. So that's where that comes in. So it's a legal non-conforming use. Okay. And number 7. The Rock and Roll Corporation of America wishes to construct an office building on a site which is not zoned for this use under the city's master plan. They could request permission to construct the building under the authority of a variance, a zoning variance, yeah. Zoning ordinances are an example of the community government's exercise of its police power that regulates what we can do, which is zoning, how we can do it, which is building codes, and what else does it cover? Floodplains. Floodplains. One more time. Police power, what we can do, zoning, how we can do it, building codes, and floodplains. You have any?
Going back to the last question,
Uh-huh.
I thought a zoning variance was for a small thing,
Yes.
and they want to construct a whole building on a site that's not zoned. Wouldn't they need to actually get it rezoned?
What's that? Are you talking about number 7?
Yeah, number 7.
Okay, it's a zoning. Okay,
Wouldn't
the
they
Rock
need
and
to get
Roll.
it rezoned?
The Rock and Roll Corporation of America wishes to construct an office building on a site which is not zoned for this use under the city's master plan. They could request permission to construct the building on the authority of it's a zoning variance. And what it's a zoning change. It's a change in the zoning. Okay, it's something that affects the zoning. And it's usually just a small change. Usually it's the complete rezoning. This is kind of an overstatement. You're true. But that's what it still would be called as a variance. You're changing the zoning on it. Okay, we got number 8. How about number 9? Land use controls are enacted for all the following except D, to assure equality in housing, whatever that is. So that's just a nonsense question, really. A city department can take private property owned with compensation by eminent domain, by means of condemnation. Good. When land is located in a floodplain, the use and control of its lands are a form of police power again, police power. Which of the following is regulated by building codes? Structural integrity. Yeah, you gonna be ready for these? You're gonna see some of these on the state exam. Don't you hope you do? Yeah, these are slam dunks here.
So do they, in the state exam, they give us some questions that really are, I mean, it's easy to figure out, like on number 9, to assure equality in housing. They do that?
What's going to happen on the state exam? Of course, on the state exam is you're going to have stuff that's this easy. Well, what's going to happen is every question you get, you're going to break it down to where there's 2. You know, it's one of those 2. So you have a 50-50 chance. It's usually what's going to happen in virtually every question you have. But you're going to know, a lot of them you're just going to nail. Because any question in this 3-ring binder could be on the state exam. Now, it's not going to be word for word. You know, I'm associated with a committee that makes up the questions for the state exam, but I don't bring them into this class word for word. That wouldn't be right. But they're going to be very close, very close. So when you're taking this, like I say, just go with the flow, and any question in this book could be on the exam. And your finals, your 201, 202, and ultimate are really close to the state exam. In fact, they're tougher than the state exam. So when you pass those, you are really ready for that exam. I'm taking the exam this week, by the way. I'm probably going to take it. I'm hoping to take it tomorrow. If they're going to get back with me and let me know. Because tomorrow's going to be a fairly short day. So, we'll see. And, number 13, I believe. The procedure which results in a small deviation in a zoning area, such as relaxing a setback. Kind of beating that to death. A variance, again. And building codes are primarily concerned with?
Structural integrity.
Good, you remembered. Structural integrity, building codes. The purpose of submitting building plans is to provide A, evidence of compliance with local authority regulations. Okay, let's go back into our other book. Chapter 17 talks about investing in real estate. And let's just kind of review some of this. Let's look on page 254. 254 in your book. Let's see. Nah, let's go back. Let's spend a little bit more time in this. Let's go to page 252. Examining different investment properties. Look at this list here, and this is hardly all-inclusive. But 1 to 4 family houses, apartment buildings, large residential complexes, individual retail buildings, strip malls, shopping centers, enclosed retail malls, office buildings, warehouses, motels and hotels, industrial properties, vacant land. Top of the next page, remember, land is one of the toughest issues to get a loan on because there's no income from land. It doesn't produce any income unless you have a billboard on it or something. The land is generally not considered a good investment unless it's being purchased to build on. For more about vacant land, check out that section titled Empty Promises Considering Vacant Land. And again, in vacant land, it's really, you see the shops where they'll sell 4th of July fireworks or something like that. But essentially speaking, vacant land is considered to be not producing any income. That's why it's so tough to get a loan on it. And then management issues. Look at the second paragraph under management issues. Many investors start by investing in small residential properties such as 1 to 2 family houses close to home. They're usually familiar with residential properties, and the close proximities enables them to keep an eye on the property. So self-management may be feasible. Moreover, these kinds of investments usually don't provide enough income, at least initially, to pay for outside management services. Very good point. How did this go? I had a guy one time, one of the students, about a year ago, I guess, and he said, I'm looking at this property. It looks like a really good deal. Can you look at it and see? And I said, what do you want to do with it? Do you want to buy it and flip it? And he said, no, I want to buy it and rent it out. I said, really? And it was in a terrible part of town. But it was a pretty good deal. And I said, let me ask you something, where do you live? And he lived in the complete opposite end of the town from where this place was. And I said, if you're buying this to flip it, that's one thing. But if you're buying it to have somebody living in there, do you want to come and go all the way across town to look at this place maybe 2-3 times a month? And you're going to have to do that. And he said, why? I said, well, you've just got to know what's going on with the area around it. And know what's happening in that area. And know what's happening with that property. And he said, no, I don't really want to do that. And I said, well, then you don't want to buy that property. He didn't even consider that as an issue. He thought he'd just buy it, put a renter in there, and wait for the check to come in the mail every month. There's a lot to owning properties. Okay. And look at the very bottom of the page, the rule of 3. Now, the Real Estate Commission is jumping all over this. When you make a recommendation for somebody to use somebody, give them 3 names. Do I do that? I try to. I really do. But I many times haven't, to be honest with you. There's some people who I know do a wonderful, wonderful job, and I've been referring them for years. But still, that's the rule of 3. We always recommend 3 people for every deal. That 3 inspectors, 3 surveyors, 3 appraisers if you're doing a listing and get an appraisal on a property, or you recommend a construction person. Give them 3 names, so if one of them screws up, they can't come and sue you for giving them that name, because you gave them 3 choices. The rule of 3. Look at page 254. Ask the experts, knowing when to get help. Wow, what I was just talking about. Knowing who to go to as far as expertise in this area, in this business. Remember, as real estate brokers, we usually know enough out there to really get in trouble, to be dangerous out there. We know a little bit about plumbing, a little bit about electric, a little bit about landscaping, a little bit about everything. And there's very few things that we are really experts in. And that's why we get these experts in there, and they are out there. And the beauty of it, whenever we get these experts, it never costs us a thing. Either the buyer or the seller pays for it. And whenever you have any doubts about anything, always get an expert in there. Look at that second paragraph there underneath the ask the experts. The 3 people who need to be consulted in making real estate investment decisions are the real estate agent, that's you, an attorney, and an accountant. These professionals need to be consulted as early as in the process as possible. And of course, again, it's important that you have people out there that you know. Somebody calls you up and says, you know a good attorney. You should know a few attorneys out there. And you always want to work with real estate attorneys. There's a difference between attorneys and real estate attorneys. If you're a tax person, you work with tax attorneys. That's the specialties in our industry. Are there real estate tax experts, real estate water law experts? Yes, there's real estate brokers who specialize in certain parts of the industry, and that's all they do, is buy and sell water rights. Things like that. And depreciation. Look at that next paragraph. Consulting an attorney is important anytime you buy a property, and doing so becomes even more important whenever you're buying property with a partner or several other people. And again, what's that called if we get together and we're going to buy one property in and out, split up the money and go our separate ways? What's that called? Joint venture. Good. What is it we're going to do that for a bunch of properties, one at a time or whatever? Syndication. Syndication. What are the 3 issues of syndication? Syndication, pooling of funds, and Securities and Exchange Commission laws, SEC laws. And 2 of those 3 will be in the question. 1 will be in the question. 1 of those 3 will be in the answer. They'll talk about a syndication. When you see the word syndication, look for the answer SEC laws, SEC license, or pooling of funds. If they have pooling of funds in the question, look for syndication or SEC laws. Does that make sense? And when I hit you with these questions, hopefully lights will come on when you see them, because you're going to see more than one on the state exam concerning syndications. Look toward the bottom of the page here. It's not so good news about investing in real estate. Investing in real estate is a good idea for several reasons. Over time, real estate values tend to at least keep pace with the inflation, if not exceed it. Properties often generate annual returns on the investment, and investors can take advantage of tax benefits that may not be available in other investments. However, investing in real estate also has a few disadvantages. First of all, real estate isn't considered a liquid investment. I can't get my money out this afternoon. Real estate investment usually requires a substantial amount of cash as a down payment, needless to say. Real estate investments usually require some level of management and involvement in property management decisions, and real estate investments don't always turn out to be profitable. There's always a degree of risk. You've got to know what you're doing. And look at page 255. Real estate investment syndicates. We just talked about it. Pooling of funds, syndication, and SEC laws. Let's look at the last two paragraphs on that page 255 where it talks about a general partnership. In the general partnership, all partners share management responsibility, profits and losses and liability. If, for example, the partners are successfully sued and insurance can't recover the judgment, each partner can be held personally liable for the judgment in a partnership. In a limited partnership, one partner usually is known as a general partner and is ultimately responsible for any losses or liabilities on the project. Limited partners are entitled to certain profits and losses if they're beneficial to the tax situation, but the partners have no management responsibility and their losses are limited to the amount of their individual investment. So a silent partner, as an example, is only limited, their liability is limited to their investment. REITs, page 256, real estate investment trusts. REIT, we talked about that earlier. We talked about how Safeway and King Soopers, whatever, they'll buy a property, fix it up, build their building, sell it to a REIT, and then lease it back from them. A real estate investment trust. Let's read it, top page 256. Real estate investment trusts are trusts designed to pool the money of multiple investors in real estate projects. Real estate investment trusts are like stock investments or mutual funds that usually invest in a series of projects, real estate investments, or mortgages. The REIT can continue as old investments are sold and new ones bought. REITs are valuable in these three different types. There's the equity trust, a REIT that invests in a number of different kinds of real estate and sells shares to investors. A mortgage trust, a REIT that uses shareholders' money and buy and sell real estate mortgage loans rather than properties. And combination trust, a REIT that invests shareholders' money in property, equities, and mortgage loans. Now, these investment trusts, you have to have at least 100 people in them. We looked into, Lauren and I actually looked, one of my partners looked into doing one of these. And we got everything all down to the nitty gritty. We figured it would cost between $100,000 and $125,000 just to set it up. Isn't that something? And then there's no guarantee of any, of any guaranteed income or anything else. Laws like you wouldn't believe coming at you, just a ton of different laws. But you have some tax advantages with a REIT. You don't have just a regular investment group, which makes it advantageous. But I'll tell you what, I'd rather just get a small investment group where you have a meeting of the minds within people with similar goals and not have to have all the government limitations on it. So, I've never been a part of a REIT. Probably never will be after looking into it to the extent I did.
Is a mortgage trust like Fannie Mae or Freddie Mac?
A mortgage trust?
Yeah. Are they just
No. No, a mortgage trust is where a REIT that they buy notes. They buy notes, essentially. They're not buying real estate. They get together and they buy notes, buy and sell notes, primarily. It's a mortgage trust. And some of those, a lot of those really lost a lot of money. A lot of them did real well, though. And right now they're doing real well because you're buying these notes for pennies on the dollar and then holding them and maturing them. I was talking to this one CPA about a month ago, and that's what he's doing right now. He's at there buying notes. He's been doing that for about 3 years, and he says he was about 3 years ago buying these notes for 5 and 10 cents on the dollar. He said now it's creeping up. It's like 30, 35 cents on the dollar. He says that, and it just almost isn't worth the risk now, because by the time you buy them, then you have to foreclose on them and on and on. He says there just isn't a lot of money there like it used to be. If you're paying 5, 10 cents on the dollar for notes, wow, you're doing pretty well. What's the government paying for notes right now? dollar for dollar, you know, for these worthless pieces of paper. And the government, when they're buying these notes, are buying them for a full amount. Really something. There's a lot to this. There's a lot to these trusts, these REITs. And then we have, let's see, the joys of leverage. Look on page 256, bottom of the page. OPM, other people's money. That's what leverage is. Leverage is LTV, loan to value. The more of other people's money I have, the more highly leveraged I am. And the more and the greater my return, if there is any return, the greater percentage it is. For example, if I have a $100,000 property and I have 95% loan on it, which means I only have $5,000 of my own money into it, and 95% is a loan that I have on it from a bank. Let's do this. 10,000. I have $10,000 into this property, and that property the next year goes up $10,000. How much have I made on my money? 100%. 100%, right? What if I pay cash for this property and the next year it goes up $10,000? I make 10% on my money. So that's how leverage works. You leverage your money, which very much increases your return on it, percentage-wise. Does that make sense? I'll use another example.
Yeah, go ahead.
What's that? Kind of makes sense? Yeah.
Don't you have to factor in the cost of borrowing that money then?
You factor in the cost of borrowing that money? Of course you would. Yeah, and what's that called? Debt servicing. Remember that? And so again, you got your cost of funds in there also. But yeah, you know, but by the time you're all done, which one would you rather have if it went up 10%? You know, there's no comparison. That's why, you know, you want to use other people's money whenever you can, within reason anyway. And make sure you're careful about who you borrow it from, too, you know. Guido is out there. Okay, let's look at page 257, talks about, bottom of the page, multi-level marketing, which is a huge part of our society right now. And there are some multi-level issues out there that are huge, huge money-making issues that are totally legal and work very well. Look at page 258, empty promises considering vacant land. And again, the problem with vacant land is it doesn't produce any income. And look in the middle of the page, we're in the money, making money by investing in real estate. Let's read this. You can make money in several different ways, such as capital appreciation, renting, and equity building by investing in real estate. As an agent and as a test taker, you need to be familiar with all the money-making methods and the appropriate terminology. In this section, what's covered is, and most important thing to keep in mind when it comes to making money on investment is that an investor expects these two kinds of returns. There's a return on investment. You expect to get back your capital, the cash you invested in the first place, and then a return. You expect to receive something more than what you invested. The expected return on the investment is related to the risk of the investment. The risk in any investment is the possibility of losing all or part of your original cash investment. The higher the risk, the greater the expected return on the investment. What do those laws call for private lending? Not for banks, but if we're making loans, what are those laws we have to abide by? Usury laws. Write that down, guys. Usury laws. U-S-U-R-Y. Usury laws. U-S-U-R-Y. And they're the rules that govern private lending. It doesn't cover banks. Banks are regulated by the FDIC and the Office of Thrift Management for the most part. Private lending is regulated by the usury laws, and every state has their own usury laws. Like in Colorado, the most interest you can charge is 45%. That's the most you can charge, which sounds like, oh, who would charge 45%? Well, what happens is a lot of these places where you borrow money, like Payday Loans was under investigation about a year or two ago because they were charging over 45%. They were charging like 1% a week. Well, that's 50%. Even though it was a 1 week loan, it's on an annual basis, that would have been a 50% loan. And so again, it's not just over a year's period, it's what that works out to. I have a friend of mine, and she was bragging that she loaned some money to some guy, and the guy was paying her 10% interest a month on this money. I said, wow, that's wonderful. She was actually taking the class. I said, that's great, except you realize that that's a usury issue, and you could end up in jail for doing that. That's again, that's nothing you want to take lightly. Well, we're private lenders, those are the usury laws that come into play. And yeah, you're going to have some questions on the state exam about it. It's for private lending, and the limit is 45%. So keep that in mind. And don't come to me after the test and say we didn't cover anything on usury. I've had several students do that, and boy does that bug me. Because we do cover usury, and more than just this one time. And look at rentals on properties on page 259, middle of the page. Look at those check marks when you're renting properties. It says the investor may believe that that the shortfall is only temporary, and that maybe the building isn't fully rented, or the investor believes rents will grow faster than expenses, or that expenses can be managed better and reduced. The investor may believe that when selling the building, it will not make enough profit to make up for the negative cash flow each year. The investor may be making a lot of money in another investment and wants to keep his income tax bracket lower by balancing a positive cash flow investment against a negative one. Those are all issues. And really, that tells you enough that if you want to know more, you can go in other places and look for it. And look at equity buildup, debt servicing, the mortgage payment or debt service, always included in your expenses. And again, letting other people pay off your property. Look at page 260. Capital gains. Look in the middle page, capital gains. Let's read this. When you sell a property for more than you paid for it, you have made what? For tax purposes, it's called a capital gain. That gain is taxable, but because the government wants to encourage people to make long-term, usually more than a year, investments over time, it treats capital gains more favorably than regular income for tax purposes. Calculating the amount of capital gain that a property has earned starts with the basis of the property. That's what you paid for it plus any improvements. The basis is the initial price you paid for the real estate, not just the cash you put in. The basis can change over time because the cost of capital improvements are added to it. A capital improvement is a permanent improvement that adds value to the property, such as a new roof on a building or a new kitchen in the rental units. This new number, original cost plus capital improvements, is still referred to as the basis. Depreciation, which is the government's way of enabling you to claim a loss on your property, and which I discuss in the next section, is then subtracted from the total of the original cost of the property. The resulting number is called the adjusted basis. We're not going to get into that in great detail. Again, it's just common sense. Anything you put into a property that you don't do just as a matter of course. Anything like adding a new room, putting in a new ceiling, anything like that will add to your basis. Normal upkeep, just correcting deferred maintenance will not add to your basis. It's doing something that you don't do as a normal course. And depreciation, top of page 261. Depreciation is the recovery of the cost of an asset that wears out. Another term for depreciation is cost recovery. And in commercial properties, the government stretched out the amount of years that you can deduct a property over. In 1986, when Reagan had the big tax decrease and brought the highest rate from 90 down to 28%, you used to be able to depreciate a property over 9 to 11 years. Then he changed it. Now you have to do it over much more, about 3 times that much. Overnight, duplexes, triplexes, and fourplexes were virtually worthless. Because most people bought those so you could depreciate them. And what happened, people started condominiumizing them. With what? How do you do that? What are those 2 terms? You change an apartment, let's say a fourplex into 4 individual units. How do you do that?
Granite and steel.
What? No.
Something to do with the party walls.
Party wall, also known as a pertinent easement, right? And a pertinent easement which is a line, the invisible line between between those units that separates them, a party wall. And so what happened is these duplexes, triplexes, and fourplexes became much more valuable just as single family units. And so almost everybody who owned one, instead of being a fourplex now, they were just 4 individual units. Even today, to do an appraisal on a duplex, triplex, or fourplex is like hitting your head against a wall, because you can't find any comps, because they've been kind of minimized, and they're just individual units now. And there are very few duplexes, triplexes, or fourplexes out there. Kind of interesting. Okay, deductions and tax credits. Page 262. We talked about that on the board. We put down a tax credit compared to a tax write-off. And bottom of the page talks about 1031 exchanges, which we hit pretty heavy. Let's read about it. Last paragraph on page 262. You don't always have to pay cash for a piece of property. You can trade, just like you did with baseball cards, kind of. Under such circumstances, the government allows you to exchange one piece of property for another. These exchanges are known as 1031 exchanges, after the section of the law that governs them, or tax-deferred exchanges, because one of the advantages is the deferral of capital gains tax. And we've talked about that in the past. Let's look at the 3 check marks on page 263. It says, terms you need to remember for the exam: like kind. To qualify for an exchange, the 2 properties must be like kind, according to IRS definitions. In other words, real estate for real estate, stocks for stocks, insurance for insurance. Again, you're doing equity exchanges, and they have to be like kind properties. Guaranteed question on the state exam. 1031 exchanges have to be like kind properties. And
So like kind doesn't mean like you can trade a residential for a commercial.
Yes, it
as long
does.
as it's all real estate.
Yeah, usually as long as it's real estate, you can exchange residential for commercial. Like my buddy changed a piece of land for a building down in Castle Rock. Yeah, like kind properties, real estate for real estate. But talk to your CPA, because these laws do change.
Can you do 1031 exchanges on things like stocks?
Can you do 1031s on things like stock? You can do 1031 exchanges on anything where you have equity. Yeah, you sure can. And again, talk to your CPA about it, because these laws do change. And these exchanges have a time limit as to when they must be completed. When I start a 1031 exposure, I've got so much time to get it done. And a boot, if properties are exchanged and they don't have equal time, even if one of the properties has increased in value, capital gains tax is deferred, but eventually must be paid when the property is sold. If the properties are not equal in value, cash or personal property sometimes is included in the deal. This is called boot. The person receiving it owes taxes on the boot. And we were talking about, I have $80,000, Benny has $70,000, he's going to pay me $10,000 because I have $10,000 more equity than he has. That's called the boot of a property.
And the recipient would pay tax on it?
And I would be paying tax on that $10,000, yes. And investment properties, that pretty much covers it. Let me check something out here real quick. Let's go to your 3-ring binder, guys. Let's go to chapter 15. Chapter 15. Do 12 quick questions here. Page 54, your 3-ring binder, the first section there. 15:1. Okay, 15-1, here we go. A mortgage contains a clause which makes the right of the mortgagee secondary to the rights of the tenant. This is called, in other words, the tenant has more rights than the lender does. This would be a non-disturbance clause. non-disturbance clause. It would be a subordination clause if it was the other way around. And all the following are encumbrances except, what's the definition of an encumbrance again? Anything that limits our what? Use. What else? Title, interest, or value. Anything that limits our use, title, interest, or value. Which of the following are encumbrances? Are liens encumbrances?
Yeah.
Sure. How about leases? Yes. How about easements?
Your car keys, Jackie's here.
Oh shoot, I forgot to open that for her. Yes. Yeah, thank you. They're right behind the driver's seat. Okay. Yes, and the one that is not an encumbrance, of course, would be a deed. That's just an instrument of transfer, isn't it?
A deed restriction be an encumbrance?
A deed restriction is the top of all encumbrances. What's another word for deed restriction? Homeowners association restrictions, which include all government plus private, right? So they are definitely a deed restriction, isn't it? Like I say, the king of all encumbrances, really. So, what? Okay, let's spend a few minutes on encumbrances. What type of encumbrances limit our use? An encroachment. Yeah, your neighbor's fence is 2 feet over my. Does that limit my use? Yeah, that's an encumbrance. So an encroachment definitely. And easement, I can't build over my utility easement, right? That limits my use. What was that, Claire?
Oh, I just said easement.
Oh, easements, yeah. And of course, a step beyond easements are deed restrictions, because they include easement plus the private. What other things limit our use? How about setbacks? I can't build right on the street, I have to build in. I can't build right on my neighbor's lot line, I have to build in. That's usually a part of zoning. What else? How about building codes? They limit our use, don't they? Those are encumbrances that will run with the land. How about leases? I buy your property, you have a renter in there, I can't even move into the place. Does that limit my use? A little bit. So rent is even an encumbrance. What type of encumbrances limit our title interest?
Deed restriction.
Not deed restrictions. What would limit our any type of lien would limit our title interest. Our title interest. And that has nothing to do with how we use the property. Whether our property is 100% paid for or we have owe 100% on it, our use is the same. So what we owe on it is irrelevant. So, but this has to do with our title interest, and that's affected by the liens on the property. And then we have encumbrances that affect the value. You're next to a busy street, next to a railroad track, things like that. So those are examples of encumbrances. So number 3, a broker negotiates the sale of a house, including furniture. At the closing, the broker must produce a bill of sale, right? The required holding period for long-term capital gains tax exemption on residential property is 2 of the last 5 years. You're going to see that sucker again, guaranteed. For a property transaction to qualify as a tax-deferred exchange, the two parties must be of like kind. You're going to see that one again. Which of the following types of ownership is least likely to be subject to securities legislation? Thank you. It should be in there on the floor.
I didn't say it.
It's in my car somewhere.
Okay.
Yes. There you go, helper, guys. Hold on. What's that? Yeah, look at those answers, guys. I'll be back in 2 minutes here. That's up along the next student there. She just had a complete mastectomy and has about 3 more operations scheduled. It breaks my heart, I tell you. She can't weigh 70 pounds. Poor gal. Anyway, where are we here? 6. Which of the following types of ownership is least likely to be subject to securities legislation?
S corporation?
No, joint tenancy. Yeah, joint tenancy has nothing to do with anything, but if limited partnership sure could be, and an S corporation could be, and joint ventures definitely could be. Which of the following best describes the method of depreciating investment property? Depreciate the value of the improvements only. Yeah, you don't depreciate the land, you remember, good. The passive investor in a syndication would most likely be a limited partner or silent partner, same thing in most cases. Which of the following has the most value? A tax credit. That's dollar for dollar, isn't it? Yeah, so B, boy. Expect to see that one again. Which of the following transactions involves the highest leverage? We have this question in our math. And what you do is you take the loans and divide them by the sales price. This is an exact question that we have in the math portion. So, we'll cover that when we get to math. The answer is C on that one, by the way. And number 11, the purchase of real estate by a group which involves one or more sponsored promoters and two or more investors is called a syndication. Syndication. And which of the following is most likely to be a securities transaction? So we got securities transaction, and the answer you want to have something with a with a syndication or rental pool. It has to be two of those three. One in the question, one in the answer. So what's the answer?
B.
B, boy. The sale of a condo timeshare with a mandatory rental pool. You're pooling the funds. Okay. Okay, guys, the next section is going to be the 280 question quizzes. And so section 11 of this course is your first 80 question quiz at the very end, right after what we just went over here in this book. Right at the end of that section in the general, you have two 80 question quizzes. And the next section, we're going to do the first 80 question quiz and then the second 80 question quiz. And those, each one of those quizzes, we're going to go over this entire book, each one of those in great detail. So, really, those two sessions are the most important part of the entire course. And this is the end of lesson 10.